Hi, today's topic is cost segregation study and purchase price allocation for real property, real estate assets. This covers not for the purpose of tax reporting or PPA, and it's for mostly it's a financial reporting. And my name is David Han. I'm a certified commercial appraiser, and also I'm a certified business evaluator and cost segregation consultant. I'm a CCIM, certified commercial investment member for more than 25 years. Cost segregation study, simply CSS, has a tremendous benefits. Without cost segregation study, the property will be depreciated with straight line method. Means it's the same amount in every single year. For residential properties, it's for 27.5 years, such as apartment in a residential property. Or other property, other than the residential property, all this commercial property is depreciated over 39 years. With CSS, cost segregation study, it's classified all this improvement basis, the shorter life, 5-year life, which is more likely personal property. In TI, since 7 years is mobile machines, fixtures. And 15 years is for the land improvements, parking lots, and the landscapings and so on. So anything but this 5, 7 year and 15 years life, remainder will be assigned to segregated to longer life, 27.5 years or 39 years. And new tax law that was effective for real estate depreciation regulation, and by the Tax Cut and Jobs Act that was effective September in 2017. All this classified as a shorter life. If you do cost segregation study, 5 years and 7 or 15 years, it can be combined as a bonus depreciation. So you can deduct 100% of it. It can be applied for the year the property was purchased or placed in service. And this provision will sunset and after 2022. It will be 80% of it in the following year, 60, and then 40% and 20%. And then after 2026, it will disappear. So this is kind of window of opportunity that you can take advantage until 2022 for 100% bonus depreciation. And one of the huge benefit on doing cost segregation study is when you do 1031 exchange, you can forego, you can have additional benefit, that is the shorter life assets. Usually if you don't do the 1031 exchange, you have a depreciation recapture. So depreciation recapture is in higher tax rate versus capital gains tax is a lower tax rate. But when you have a cost segregation study, it just write it off. So when you do the exchange, the basis will be lower because of you're already depreciated out and then all taken away, write it off, and then you do not need to exchange to the higher price because it's a foregone. So it's a tremendous benefit. I'd like to present for the 3 different kind of actual cases of cost segregation done for office building and shopping center and medical surgical center. The first one is actually office building. It was a 14-story office building. The purchase price was $37 million. And the land value, after the land value, the basis for the cost segregation was approximately about $31 million. After cost segregation study, it classifies such as 5-year life, almost like $6 million. That was about 19% of the improvement basis. 7-year life was not much because of the high-rise building. And 15-year life class, the parking lots, landscaping was approximately about 1%. So total eligible for 100% bonus depreciation in first year, which is 5, 7, 15-year life class, it's about $6.4 billion. So the comparison with the prior tax law, which is pre-2017, if it's done for prior tax law, it was 2.4 million. So that is an increase of a depreciation benefit by almost like $4 million. So assuming the tax bracket of 37%, actual tax savings was almost like a $1.45 million. It's a huge benefit. And another one is a shopping center. The size was about 32,000. Purchase price was $17.5 million, and you can include the closing cost into the basis, and then you subtract the land value. Land is not depreciable, so the basis for improvement basis was about $7 million. The outcome, 5-year life, about 22%, 7, 15, and the 39 year. Anything remainder of 5, 7, 15 year is all goes to 39 years. It will be depreciated over the year as straight line method. So total depreciation was about $7 million, but in the first year, bonus depreciation was about $2.3 million. It's quite huge, the first year benefit. And next one is medical surgical center building. It was not that big, about 13,000, and purchase price was about 4.3 mil, and closing cost 58,000. Land value, you subtract that, so the improvement basis was about 3.7 mil. Outcome is 5 years life, about almost 19%. But it has the lot of 7-year life, machinery and any kind of equipment, all those about 7%, and has a large parking lots and landscaping. So 15-year life was about 7%. So first year bonus depreciation was about $1.25 million. And I'd like to talk about now the purchase price allocation. Commonly we say PPA for real estate. And for ASC, Accounting Standards Codification 85 under the FASB financial reporting. This PPA, it can be done like a cost segregation study. Cost segregation study is for tax reporting, basically. And PPA can be done tax reporting purpose as well. But mainly I want to talk about more of financial reporting purpose. For the tax reporting purpose for the PPA is simpler than financial reporting purpose. This financial reporting purpose is under the GAAP, generally acceptable accounting practices, and that business combination ASC 805, and it's subject to the fair value reporting. It's not a fair market value, fair value reporting standard. So tax reporting purpose versus to financial reporting purpose, it has a different outcome. This purchase price allocations are required for every controlling transaction. The acquirer complies with GAAP, the generally accepted accounting principle, with a varying complexity based on the entities and assets involved in the transaction. So it is quite a complex than the tax reporting procedure. If the transaction does not meet the definition of business, the transaction is accounted for as an asset acquisition. But as of 2017 now, the new guidelines said most real estate acquisitions will be recorded as asset acquisitions. So now it's effective as of 2019 mostly. The market participant view as a fair value. The buyer, usually of institutional grade quality, that multi-tenant office buildings and regional mall large scale, is not only the purchasing the underlying land and building, the bricks and mortar, it is also acquiring all the lease contract in place, along with the various implications driven by those lot of underlying contracts. And all these properties are income generating property. So there are tenants are there. The appropriate methodology varies the best, reflect market participant application, because we are talking about the fair value. As such, the property is typically valued on an as vacant basis, using the cost approach and income approach, and also other kind of a methodology here. The cost approach is supported by a gold dark income analysis, which capitalizes the future income stream associated with the property, but under the hypothetical scenario of complete vacancy. And sales comparison approach is also employed, but primarily as support to the fair value conclusion. It's kind of a mixed kind of a feeling that traditional commercial appraisal use all this kind of approach, but it has a different aspect. The traditional commercial appraisal is due of more of fair market value, but financial reporting is more of a fair value conclusion. It has a different concept. Usually the commercial appraisal does not distinguish much of in leased property as a tangible, intangible component. But in fair value conclusion, it has tangible, intangible assets in aggregate because of at least the fee nature of similar investment grade transactions, in which all real property assets are conveyed in one bundle of rights. So PPA process has two aspects. One is tangible asset, and the second aspect is intangible asset. The tangible asset is very much of a self-explanatory, as known as land value, building value, but it's as vacant, not as occupied. Site improvement and FF&E, furnitures, fixtures, and equipment. And unamortized residential costs is like a TI allowance, a TI. And then leasing commission is assuming depending on the remaining leases. And other personal property is tangible asset. And the second aspect is intangible asset. This is not easy to do. So I want to just go over the brief explanation. The actual job is done by the professional. So just understand is just as good as you know. And lease contract, it has it can be above or below market, and if also capped leases, and has a component of legal marketing fees. Lease is in place. If the remaining lease as such need to be analyzed differently. Above, below market lease, tenant and customer relationships, unamortized leasing commission, those kind of lease contracts need to be analyzed. And also, second is service contract. And if there is any favorable purchase contract, and also trade names above, below market, debt, also not only the asset, all those liability need to be estimated. And then recognize and measure the goodwill, recognize and measure the bargain purchase gain, access development right, which is if the property has some access land or surplus land, if you can develop that land or have some kind of entitlement to add the value for the future. So all those value as a present value need to be added back to it, that as intangible assets. And also many commercial property has a signage income or billboard income stream. There's many other prominent street or large shopping centers has some kind of billboard income, which is a huge income stream. So all this kind of need to be captured as an intangible asset, not as a business combination standpoint, but intangible asset to as a bundle of rights into the real estate. Thank you for joining. So you can visit to contact on my website. And thank you so much for watching. Please subscribe for the next valuable presentation. Thank you so much.